This is not a rant. All right. Good morning, Mick. Good morning, Secret Agent Charlie. Good morning, Jim, Michael, Les, Ed Mines, Carol. Good to see everybody. Hope you're doing well. Good morning, Eric in Northport. Saw that you got here early again, 7:48. I think I woke up at 7:48, as you could tell from my hair. So today, within the kind of the checklist, remember, one of the things I think is important just to remember, what do we do here? What are we focusing on? Understanding ahead of time, having a plan going in. So very first thing, right, is just the broader momentum rating. And we do this every day. A very simple metric, right? It is the number of stocks breaking out versus the number of stocks breaking down. There are 7 directions that stocks can move according to the dissertation that we cited from 2016. And right now we have 24 names, more names breaking out on the S&P 500 than we did downside, right? So conditions strong. And what's going on? Lots of liquidity, lots of common money. We're going to talk about what's happening with the Fed and what they're not doing, but apparently are doing and saying they're not doing. Yeah. Okay. What's in strength right now? Tree starting to see some movement now in the financials, and this is waking up a little bit. I do like this as a short-term momentum style move. If we can get everything to cooperate at the same time, pay very close attention to the ADX here. We see a positive move on the ADX, and we can get the RSI up into around that 50 to 55 level. That's going to be an entry point for Tree. In addition to that, I've been talking about this for the better part of 2 weeks. Palladium. It's not this chart that I like. It's not the strength that we've seen here. It's this. This is the long-term focus here on Palladium. And it has that feel of what we saw with the S&P 500 in 2022 when everyone is effectively stating this is terrible, horrible trade numbers, a lot of questions around EVs. At the end of the day, the U.S. economy, a lot of strength and a lot of reliance on the automobile sector. The gas-powered automobile is not going away, and the catalyst converters are still going to be needed. And as the U.S. dollar is weakening, this is playing into strength. PALL, MGA is the other name. This, as we were talking this morning, this feels like one very simple trade deal away from just absolutely running. MGA, keep it on your watch list, but it's really PALL. I'm probably going to go in on this and stay in this. I had said that my entry point was 97.50 when we first started to analyze it. Well, we're at 99.90 now, and this is a long-term play. So I'm looking for a nice move higher on this and just continue to allow Palladium to run. In addition, BWIN. I don't know. I think somebody's trolling me on this one. Baldwin Insurance. Who are you? Baldwin Insurance Group. Just keep an eye on it. It's been bouncing around, but it's really kind of this like one 30-minute chart. Just see if we can focus on this stock and focus on this name using volume-weighted average price today. I don't know necessarily what it does. Would I buy PAL? I'm buying it. I'm buying it. I'm buying Palladium. And I'm going to hold that because, again, no one's paying attention to that metal. We're seeing platinum rally this morning. Dollar continued the weakness. I like that long-term chart. I think it's pretty simple. Not that complicated, right? So just staying long here. And this is not something for, the next 2 weeks. This is a longer-term play. Okay? Baldwin Locomotive. What's weakening? Interesting, but not really that interesting, right? Ovintiv, OVV. This is a name that keeps popping up on my list, largely because I think it's a takeover target in the Permian Basin. And they're one of those companies that's really in the innovative space in E&P, particularly with Trimul-Frac, which is supposed to be the technology that's going to expand drilling capacity and reduce costs. But this stock just cannot get up off the mat. Looking at the other spaces, companies like Oxy, companies like NOG. It was a week and a half ago that we were praising this and watching the momentum run. Now these stocks are breaking down, falling under their moving averages. I think oil is probably heading much lower. And now the question is, if this breaks under that 50-day moving average, how much downside does it have? It's a good little place if you're trying to focus on ways to short the energy space right now because the sector continues to weaken. Remember, the momentum stock that I like to trade on both sides of these moving average is Apache. So APA. Keep an eye on it. In addition to this, we are looking at WIMI, Yala, and JD. Yep, we're going back into the Chinese names. And why does that matter? Well, it matters because we look at a company like JD, and this is another name that continues to just bounce around, pop around. Something's going on in China. I don't know what it is, but I think there's probably going to be a little bit more action, a little bit more activity from their central bank in the near term. Keep an eye on all these names because again, it's all about the yin and the yang, right? The yin. This is a leveraged ETF that is effectively following KWEB, and if you look at KWEB holding above these lines. So looking for KWEB to maintain its strength. I don't really like trading Chinese stocks too much unless it is good old-fashioned Baidu. Baidu is actually a really, really cheap name, and every time that it does start to get above these moving averages, it can run pretty fast. You've seen a couple of moves like this, $10 to $15 moves on Baidu. This is a really cheap name in terms of its intrinsic value. I think it's trading at like 0.6 or 0.7 gram, and it also has a very high F score. So looking for strength here, looking for the continued movement. I will probably be taking shot at Baidu today or tomorrow. Across the board, things that we always look at every single morning, insider buying to selling remains relatively weak. Not a whole lot going on in this environment. I have a long-term position that we've been managing in a different place around Occidental. So we're probably, because of the weakness in the energy space and the long-term exposure to Occidental, would be selling calls on top of things that we own. This is a little concerning, obviously, the fact that insiders are not stepping in and buying their own stock, but I want you to just remember we are in the middle of a blackout period. So we have earnings coming up. There's not going to be a lot of action or activity, and the insider buying at the moment is relatively quiet. If we do a quick screener like we do every day, and we specify only on CEOs and CFOs, nothing has happened in the last 24 hours, which is concerning and frustrating. And, we want to be able to identify opportunities, but there's just nothing there. And when there's nothing there, you move on and you turn to 13D filings. Well, what do you see out of 13D filings? Not a whole lot. Not a whole lot of things that are very interesting. I do always look at, when somebody is buying up things like this, the Invesco ESG revenue ETF. I'm not buying it, ESG. I'm just really interested in what the hell that actually means. So what are the holdings of this? Because at the end of the day, a lot of this stuff is it's just fluff, right? Wrapped in marketing language. What are they considering ESG in this space? And is this trading at a discount to its net asset value? Because that's typically why anybody would own any of this stuff in the first place. Advanced Microsystems, Western Digital, Estee Lauder, Micron, Intel, Northern Trust, Newmont, Mining. That makes sense. Yeah, that's ESG. Sure. Carnival. Sure. Cardinal Health. Sure. Whatever. You can call anything ESG. Anything you want. It does not matter. That word does not mean anything anymore. So don't worry about it. But it's always interesting to see somebody, in the fund space stepping in and buying some of this stuff, and then just taking a couple of minutes and looking at it, because typically it's not what it says it is. Plug Power. This is a weird filing. Nothing. We didn't do anything. Grove Energy Capital didn't even bother. Nothing. Just had to file their 13D. No change whatsoever on the quarterly side. So that's from today. If you go back to yesterday, just in case we miss anything, nothing really significant either, right? So people aren't putting a ton of money to work, but we will start to see this shift in the next week as we move into the third quarter. Third quarter is always an interesting time. Next week, I will be doing a really quick preview on Monday of something that I do every 6 months. We put together a portfolio of F and G score stocks, high F score, low gram score, and we are looking for very specific momentum to return to this market. So one of the things that we're going to be doing here, we're going to have a little bit of a product that we're going to be giving away for a little bit in about a month and a half. But I'll start just kind of previewing some of the stuff during the show that I do at 12:30, which is another reason why you need to be a part of this community. Click the link, choose your price, let us know what you think, and I will be putting together a portfolio of these names, and we're going to be actively trading them over the next couple of months, and you'll be very surprised by the companies that are on the screener right now. Currently looking to try to build a portfolio of about 7 stocks. I might take it up to 10, depending on whether or not there is enough optionality around some of these names. Typically, a lot of these names will be in things that you might not actually think have a lot of value right now, particularly in the shipping space, and a couple of Chinese stocks as well. They just do keep popping up. What stocks are breaking up? What stocks are breaking down? Well, we can do all that math if you want to do it, but really quickly, just take a quick look. As I said, our measurement of momentum pretty simple. You just want stocks that are up on the month. You want stocks that are up on the week by 5%, and then we're just going to set a really quick beta of 1 to 2. And the reason that we're doing this, I'm not taking you through the full proprietary element of this. I'm not taking you through every single sector. A lot goes into that. But if I want a poor man's version of this, I just want to know the number of stocks breaking out in the last 5 days versus the number of stocks breaking down in the last 5 days. The poor man's way to do this is really just to do 2 things. You measure the number of stocks breaking out 5% or more, and then you do the stocks breaking down. And then what you do is if you see a negative number, you look at one of 2 things. The SPXL, which is the S&P 500's leveraged ETF, and you look at the 20-day to 50-day moving averages, and you look at the FNGD. The FNGD is that inverse ETF that I keep talking about that nobody really seems to want to actually recognize as one of the best signals in the world. If we have a negative number and we are now moving above the FNGD on its 20-day moving average, there may be a serious problem in the financial system. We don't know what it is yet, but we ultimately will find out in a couple of weeks or a couple of days. This is a perfect example. Last year when the Nikkei had its worst sell-off since 1987, everybody woke up and said, wait, what the hell happened? Well, the market was telling us ahead of time. So just always keep an eye on this. And of course, just keep an eye on the UVXY or keep an eye on the VIX. It treats the exact same thing. You know, the UVXY, which is this kind of crazy broken short-term volatility product. Look, it breaks above its 20, it breaks above its 50. Something's up. But it's not necessarily as apparently as powerful and successful based on the back testing and based on the analysis as the FNGD. 50 stocks breaking out. Right, 50 stocks. Estee Lauder, that great ESG stock that we just talked about, part of that ETF. You're seeing a lot of names here, Jabbles in here. You're seeing Citigroup. You're seeing banks. There's been a little bit of an accommodation for the banking sector. That's going to be relatively significant in the future. But you know, the stocks that are breaking down, you're probably going to start to see showing up are going to be in the energy space. So be careful if you are long energy. As I have said time and time again, the big problem that I have in the oil space, we just want to watch the OIOU, and if that is above its 20-day moving average, be long certain oil stocks, and if it is under its 20 and its 50, it's time to short energy stocks. SLB is getting beaten up. You're going to probably see a handful of oil and gas upstream stocks start to pop onto this list in the next couple of days. The OIOU currently under its 20 and its 50 EMA. I will look at the SMA. It is currently under its SMA, still above its 50. So you've got about a 5% window here. I just don't like speculating on upside in oil until we see oversold conditions on both the MFI and the RSI. We are kind of in no man's land on the RSI and the MFI, money flow index and relative strength index right now. I'm being asked about Vera Therapeutics. Oh, biotechnology. Very light volume, beta 1.16. I don't know much about the biotech space, but one little thing. What is the LABU doing? The LABU, if this starts to break out, Vera will probably go with it. This is kind of like when I'm trading the OIOU, LABU is basically the biotech signal as well. Very important that you just keep an eye on these things because if they are starting to push aggressively above their 20, they start to be the momentum algos really start to turn on around a lot of these stocks. RXRX is a company that we watch, Recursion Pharmaceuticals. It's basically like dead aligned with the LABU. So when the LABU starts to break out, this is one of those little names that we'll be paying very close attention to. This is AI, healthcare, just not a lot of people paying attention to what the company actually does. I do not use the 100 and the 200. I use the 20 and the 50. That's it. The 200 becomes like that line in the sand, particularly for the S&P 500. We have hit the 200-day moving average a couple of times, 08, 11, 15, 18, 20, 25. We got close in 25. When that happens, that seems to be the line in the sand for the Federal Reserve to step in and basically pump money into the system. I don't know what the hell would be happening to the financial system if we were under the 200-day moving average for a longer period of time. Probably nothing good. As always, make sure that you keep your trading view or Thinkorswim open. There is no volume on the SPX on Thinkorswim, but there is here in TradingView. I don't know why. I think it has something to do with pricing with futures and options. I've never asked because I don't want them to take it away if I do. But once again, all you're looking for on the SPX is a move down into the third to fourth deviation. This is the bottom of the third standard deviation of 1 minute volume weighted average price. As you can see, what happens when we get down there, the algos wake up. And we have these very short period of time where you can turn around and trade the SPY, the S&P 500 SPDR ETF, the S&P 500 ETF. Just buy the in-the-money call when you get down here, and then look to just scalp and sell. It's going to be quick. It's going to be fast, and you just keep a relatively tight stop on that option. You can also just use the SPY as well if you want to, or the SPXL. But as you could see yesterday, when we got into this arena right here, that fourth band on the SPY, the 605 got back to 607 within about an hour and a half. I wasn't really focused on that. I'm focusing on the move from 605 to 606.75 in about 5 to 10 minutes. It's a very fast trade. And once again, we had continued to focus on this. The bars in this chart are first, second, and standard third. Yes, absolutely. And the settings are here. So if you are in Thinkorswim, or forgive me, in Thinkorswim, you have to set up every deviation band one by one. But if you are in TradingView, the indicators that you're going to be putting in here, once again, just real quick run through, and we have video on all of this. What you're going to do, make sure that you're on a 1 minute chart and your indicator is VWAP, volume weighted average price. It's going to bring you the blue line, which is obviously volume weighted average price. Then it's going to give you the first deviation. And yes, it is, because the band multipliers are measured in standard deviation or percentage. You're doing standard. And then here you go, 3 bands. Now you can change this and you can go 2, 3, 4, and it's going to change the chart a little bit dramatically, but it's valuable to have the fourth band on there because all you're really looking for is that moved and confirmation that you are now in that spot. Very important. Okay. Finally, on top of that, just stocks that are breaking out, breaking down. We have a screener that we run on over here. We have on stocks that are in breakdown mode, 38 names. So this is just a list, just things that kind of pop out. These are things with weakening RSI, weakening MFI, weakening MACD, and falling under their 200-day moving average. You got SLB. We talked about that. You have waste management dropping as well. Just kind of 5. What is that? I forget what FIVN is. Anyway, HIMS continues to get beat up. This is a fascinating momentum stock that has 2 massive swings this year. It's now broken under its 20 and its 50, and I think a retest down here of that 200 is definitely back in the cards. Really, one of those names that has really just been focused on hype. Very overvalued company. That news last week was absolutely dismal for the company. You've had these really significant breakouts. So if you don't want to short it, you don't have to. Just be very well aware that the next time that we start to see that upward slope, HIMS becomes a very strong momentum stock, and it doesn't need a lot of news to drive higher. It has a very high short float, 32%. Right. So squeezes are pretty common here. We've seen two big ones in the last couple of months, but now it looks like the shorts are clearly in control of the situation. On top of that, we switch over and we look at breakout names. Got 36 on this. BSX. That's the first thing. We got a couple of banks on here. Banks are starting to come back, and Bumble is up 25%. I forgot that was a thing, but then again, I'm married. ARE, people had asked about that yesterday. That's a Alexandria real estate. Not really my thing, but I will take a look at that chart later today during our conversation. MHO as well. We're starting to see, again, these housing stocks waking up. They are very dormant. They are very cheap. And at some point, something is going to come and happen, and it's going to lead to a reversion on these names. I've tried a couple of times looking for those moves above these moving averages. I've stopped out. It just takes one event, one single thing that can drive these things higher, these undervalued names. MHO, very good momentum stock in the past for me as well, particularly last year. But we were trading this, I recall, back in October of 2023, and this was one of our runners in early 2023. It had gone from 47 up to about 100 before giving way and then turning back around and chugging higher after finding support on its 200. This breaks above its 200, it's going to be lovely. Married men can use Bumble too. Doing what? Looking for people to hang out with? I don't know. No thanks. I'll sit here in my basement. It's fine. Let's see. What else do we have? So we talked about that chart. The couple of quick things I think are just very important and very relevant is just to really kind of wrap our heads around some of the broader macro stuff that's going on in this environment, and just to kind of give you a little bit of a sense of what we already know and what is basically just become the status quo in our policies. This is not a rant, don't worry. I'm just going to briefly just point out, though, that there's two major issues that have transpired in the last couple of days. First off, it's this basic idea that the United States Federal Reserve is in any way tapering. They have said that their goal was to go from 25 down to 5, cutting the balance sheet. We went through the numbers last night. It's insane. You have had, just since June 10th, 60, the SOMA number, $30.3 billion that the Federal Reserve has not engaged in quantitative easing around during these auctions. And most recently, yesterday, 263 million, 6.9 billion on the 25th on the 5-year note, 2.3 billion on the 42-day on June 24th. Look, at the end of the day, this is about liquidity and backstopping the system. And what we are seeing in this environment, which is so bizarre, is, again, I say it all the time, do not pay any attention to what they are saying. Focus on what they are doing. And it's all showing up in the SOMA report. It's all showing up in the Treasury numbers. There is a line in the Treasury auction report that says SOMA. And sure enough, like, you sit here and you wonder, how is it that we are back at near all-time highs? They're pumping money into the system. They're keeping it there. They're not allowing money to get sucked up on the 10-year, 20-year, 30-year yields. They're focusing on short duration. This is how the markets have worked. They operate on capital and policy, and they have done so since 2008. There have been studies done that between 2008 and 2015, roughly 100%, nearly 100% of the market was driven by policy. And since COVID, it has been the same thing. And I've shown it multiple times. At the end of the day, it takes a lot of money to keep this market coming in, and it takes that credit creation to do it as well. So Don't be shocked if we keep going, if we keep chugging higher. You have to suspend your belief a little bit. Now, on the other side of this, what's very important to keep in mind is that Powell came out and said yesterday that the Fed would be cutting rates right now if they followed the actual data. If they followed the actual data, they would have cut by now. But officials fear that the tariffs might cause inflation that hasn't materialized yet. In 2018, Powell issued a warning, and he said they would not allow speculative or poorly grounded forecasts to drive policy. They have not been right about anything since 2018. The Fed data, inflation is at the target, 3-month annualized rates of around 0.6 for the headline and 1.4 for the core. And yet Powell is paralyzed by models that predict tariff inflation despite evidence that the tariffs aren't inflationary. In 2011, the Fed ignored surging inflation because the model said it was transitory. Now they're ignoring disinflation because the models predict future inflation. And once again, they're trusting forecasts over facts. Credit-sensitive sectors are weakening, but Powell would rather wait for confirmation of his fears than act on current reality, which means this central bank has abandoned data dependence and forecast dependence. Why is that important? It's going to be important soon because if we start to see disinflation, if we start to see deflation, the money printer is going to turn on and go full blast, and we are going to see QE like we haven't seen in a while. It's just insane. But at the end of the day, the most important thing that we know is that if something does break, we're going to see it. We're going to be on top of this before everybody else knows what the hell is going on. Because we know that all we really have to do is pay very close attention to just a couple of key lines. Watch the 20 and the 50 on the SPXL. Watch the FNGD and see if it breaks above that 20 and 50 day. Do the calculations of momentum. This has not been wrong since I started doing it in 2020. Now, I'm not going to tell you that if it breaks the 20 that we're going to have a massive event, right? Because in September it happened. And this was around debt deflation concerns in China. But there was reportedly, according to Hal, a pivot by the Chinese central bank, the Bank of Japan, and the U.S. central bank. There was something similar that happened in 2016 called the Shanghai Accord that Janet Yellen denies ever happened. But it drove it created a V-shaped recovery for the S&P 500 and the Chinese stock market in the beginning of 2016. Also, at that time, we saw the largest amount of insider buying that we had seen since the 2009 quantitative easing start. So in addition to this, recognize that if there is a major policy event coming up, it will show up in these charts, and it will also show up in the insider buying. That's it. So just be patient, wait for it, and we'll see what happens. But every single auction that we have talked about, right, the Fed is stepping in and they are buying. And that is supportive and accommodative to the system because, again, we can't crack the bond system. If we crack the bond market, the S&P 500 is going to get crushed. We saw that happen in 18. We saw it happen in 2020. We saw it happen in 2011. We saw it happen, obviously, in 08. And then we had that freak out at the beginning of April. When the bond market starts to roar and starts to get sick, that is where all of a sudden accommodation comes. Look at Palladium go. There we go. Keep going, Palladium. So we got 5 minutes. I got any questions? Again, the FNGD, there is significant fees and significant decay, P-Butts. Don't buy it. You're not buying it. This is a signal. This is one of these things. I just want to point out there are all of these weird things that we have pulled up that we have discovered and that we have used for 5 years. And nobody knows what the hell they are or why they even exist. Or they haven't studied them enough to understand that these things have extraordinary predictive power and no one has known how to use them, right? So when I look at the FNGD, I'm just going to show you that nothing good has happened, right? All the bad events that have transpired since 2020 have all happened when you were above these lines. And that might sound like, well, that's dumb because obviously, it's like saying that volatility. I understand that. But where does it start? It really starts because what happens here is we have this signal, number of stocks breaking out, number of stocks breaking down, going back and analyzing J.D. Henning's dissertation, multivariate analysis of reversal patterns and momentum. That was from 2016. That's the 400-page dissertation that has the lines of all of the different positions and ways that stocks can move, and that is where the original theory starts. And what we have seen is that when that number goes negative, breakout stocks versus breakdown, and we have an FNGD moving above the 20 and the 50, something bad is going on. Money is already left. Right? It takes a lot of money to keep the S&P 500 moving higher. So that's the first thing that we see. The other thing that I've said time and time again, you have to follow insiders. You have to look at these ratios. This is the amount of money that insiders are buying to selling. And over a 20-year chart right here, this line right here, right? Where are we? Yeah, right here. This is the blue line. And I have a different version of this. I have it on a distribution level. But the blue line version of this, you could see, this is executives putting their money down. And they're putting all of their money down at the peak of every major crisis we have had since 2008. And every single time that this has spiked, there has been a policy change that is accommodative to the financial system. 2009, this is the first QE. This is the 2011 pivot by the European Central Bank. That was a huge crisis that nobody really even remembers anymore. Most people didn't even know that China melted down in 2015. It was really bad. This was like the ghost towers and the ghost buildings. You look back on it and you go, oh yeah, I remember that headline. No. China's entire financial system nearly collapsed. It nearly collapsed. And there was a bailout, and there was the Shanghai Accord that Yellen denies ever happened, but a lot of evidence that the central banks provided support. 2018, we had Volmageddon, and then we had this big bond freak out at the end of 2018 that ultimately led Powell to have to cut rates and then pivot and start QE4. 2020, you know what happened? They dropped $4 trillion from the sky on March 28th. 3 days after Bill Ackman's on CNBC screaming, hell is coming. Well, Ackman knew what was going to happen to the bond market and knew what was going to happen to the credit markets if they didn't do something, and they did. Again, pay attention to Ackman. He knows what the hell he's talking about. You love him or hate him. Like, he was right there. He was right in 2022. He was right in 2023, and he's right now. So, doesn't matter. Don't shoot the messenger. And then you had the gilt crisis that happened back here, and then you just had this spike here. That's April. Right? It wasn't as significant because it wasn't a fiscal or a treasury policy shift, but the insiders knew. The people at the top of the companies who spent tons of money, not just on corporate consulting, but on monetary policy and fiscal policy consulting. They do it with Booz Allen Hamilton, and they do it with a handful of other people who are on the ground on K Street. And they get briefings, and they go, oh, policy change is coming, I'm going to buy my own stock because it's going to go up 20% in the next 3 weeks. It's just how it works. So you subscribe to TradingView. Can you quickly add VWAP? I can't see how to put the 3 and 4 back in. So very good. This was the last point that I wanted to make anyway. So TradingView, I don't know why this exists. I don't know why. Like, it's like the FNGD. I don't know why it's there. I'm not trading it. I'm not looking at it. I'm not using it. I'm just monitoring it. So with the SPX, right, this is what will show up. You're on a 1 minute and you're on an indicator. There's no volume on the SPX on Thinkorswim. But all I have here is this weird tool that for some reason, every time it gets down into this lower end of the deviation, we start to see algos stepping in and buying, and we see these short-term reversal patterns. Okay. And the thing I'm going to say time and time again, trade it till it breaks or until this goes away. So the SPX, here's your first level. You are then going to just simply go into VWAP session and go to the settings, band 2, band 3. Now, if you want to add band 4, you simply make your first band multiplier 2, the second one 3, and the third one 4. And why do you do that? Because it doesn't matter. You're not trading the SPY in these ranges. You're trying to do it down here. You know this is the 4th deviation. And if it gets down here, you flip over to the SPY because the SPY is what you can trade. And you're focusing on short-term in the money. Okay? Very simple. We've got to do something with the scans, Chris. I'm still trying to figure all this stuff out. But yeah, we'll talk about that, and we'll do more on that later today. SPXL, not SLXL. The FNGD and the SPXL. That is the triple leveraged ETF of the S&P 500. Again, the reason that we focus on this is because of the leverage in the system. When the leverage starts to break down, and we start to see that, hear that sucking sound, when this goes, it goes fast. And what's nice about this, if you want to trade on the other side, you don't need to use options on the S&P 500. You could trade the SOXS. Yes, there is decay. Absolutely. But as you could see, the SOXS went from 20 to 50. Back here in August when it broke its 20, it went from 21 to 40. And then this was the short-term lending money market spasm that we had last April. This went from 34 to 46. So be tactical about it. That is your hedge against the S&P 500 in the event that you were concerned that the markets are going to fall. And if it breaks down and falls back under its 20-day, you lost $1 on the SOXS. Can you add VWAP 2X and set the... You can probably do that, but again, I'm only focusing on the 4th deviation band. I don't like, what does the 5th and the 6th matter? It doesn't. If you get down into the 6th deviation of the S&P 500, something really bad happened, or it was probably a fat finger event. All right, I got to go because Don's going to kick me out of the room, and I hope everybody has a great trading day. I will be back a little bit later today. We'll go through those scanners, and once again, make sure you check out Mr. Tony Ragu. 12-week mastermind kicks off, and I just want to make sure that everybody knows, it's a really good time to be trading futures in this moment. So click that link, and I hope everybody has a good day. We will 18 week, even better. That's 6 more weeks of Tony. See, what a day. All right, I got to get out of here. How do I get out of here? Where's the door? How do I leave? Have a good day, everybody.